In this video, we're going to talk about fair value gaps and which one is correct to choose. So stay tuned throughout the whole video. So the chapters that we're going to cover in this video is what is a fair value gap. We're going to cover that in detail. And then we're going to see how a fair value gap can be spotted on a chart. And then we are going to see how to use the fair value gaps. And lastly, I'll show you the tool that I use to spot a fair value gap in the market. So let's begin with the video. So the first thing that you need to understand is that we're going to even do some examples, and then you'll get this free PDF. The link will be in the description. You'll find it on Discord or Telegram. So let's start. A fair value gap in a bearish trend is a price imbalance in candlestick, and also it happens mostly when price is moving too fast, like with this kind of candlesticks that are very big in the market. So in a bearish trend, you'll understand and see it by the first candlestick and the third candlestick. Their wicks must not touch each other, like this one here. So that means there is no fair value gap here. Prices fill the fair value gap. But on this one, you can see that we have 1 and 2 and 3 here. But the wick of the third candlestick and the first candlestick doesn't touch. That is why you see a space here. You can see a space from here on the low of this candlestick and then to the high of the third candlestick. That is why you see this move here. This space in between the wicks. This is the space here is what we call a fair value gap. So if you understand what is a fair value gap in the market, it's just a space between high and low, the high and the low of the previous candlesticks. So because here we will be in a bearish trend, you have to understand that you might even see a lot of fair value gaps in the market here. You'll see a lot of FVG, but you don't know which one to choose. So in this video, we're going to talk about that. So let's move on to a fair value gap in a bullish trend. Here in a bullish trend, you will see that the first candlestick here on the high and the low of the third candlestick, they touch each other here. So that means the fair value gap has been filled. And unlike support and resistance, fair value gap is a one-time use. They are not like support and resistance where price is to like retest that level a lot of times. So in a support and resistance, we already know that price can retest here, come and retest here again, like multiple times, like this here. So a fair value gap, if it's like this, that means the price has filled that gap. And most of the time, these gaps here, like here on this area, you will see that there will be like a strong move to the upside, like this. But if you move on to the lower time frame, let's say you have a fair value gap around this area. In the lower time frame, you might not even see those fair value gaps because the market will move like very slowly in the lower time frame. So those gaps will be closed, but in the higher time frame, you'll see that there is a gap. So in a bullish trend, obviously the high and the low. If there is a space in between these two candlesticks here, that means we have a fair value gap. So right now, let's see how most of the traders use these fair value gaps in the market. In the market, you'll see that fair value gaps can be used for take profit, retracement, analysis, or to put your stop loss level. Let's start with this one. We can clearly see that we have a fair value gap here. And before I forget, this one here is the first candlestick, we have the second, and then we have the third. If there's a space in between the third candle and the first candlestick, like this one here, we can see that the wick here doesn't touch here. That means we have a fair value gap. So from here, you can clearly see that price tried to close it, but it didn't close. So if you want to make your entry, let's say you make your entry here, you can still try to target this area because we can see that we have a gap. So your trade will look something like this, meaning this will be your take profit. This will be your stop loss. Then when price move to the downside, you can use the fair value gap as your main target to close that gap. So your entry here, and then your stop loss around, your take profit here. This will be your stop loss. So let's look at the retracement. Most of the traders, sometimes they can use the fair value gap for a retracement, like to trade below a low, or maybe to take out liquidity and then move to the upside. And you can clearly see that we have this fair value gap and even this one. So it all depends on which one you want to use, but in this situation, we'll cover that in a moment. You can see price just retraced into the fair value gap, it closed this one, and then it moved to the upside very aggressively. That means this market was very strong during that day. So for those who uses FVG for analysis, they can predict that the market is likely to retrace into this area and then move to the lower time frame to make some analysis for the move to the downside. Let's see what really happened here. Can clearly see that the market traded around this price level to close this fair value gap and then traded lower. So another trader can use this fair value gap for a stop loss level. We can see that we have a fair value gap here, and then they might take the entry here for sell, put a stop loss above the last candlestick here. Like this will be, let's say this is your first, your second, and the third. They will put their stop loss right there, like this way, above the candlestick that created the fair value gap. If like it was on this side, they will do something like this. Stop loss here, even on this one, stop loss here of this fair value gap. Even on this side, they can try to put their stop loss around this area here. So if they make the entry here, they can put a stop loss around this area, and then they will wait for price to move to the downside. So that's how you can easily understand fair value gaps and how to use them properly. But before we begin, I have a tool that can identify these levels here. Let me show you. The tool that I use is an indicator from Flux Chart, which is price action toolkit. The indicator can be found in the indicator section, invite only. Obviously, this is not free. This is the indicator here. Once you add this indicator, it won't look the same as mine here, but I can show you my settings if you have this indicator here. These are my settings here. I've turned everything off because I want to see only the fair value gaps. You can see on the fair value gap, I have enabled it from the green to the grayish one. Everything is just off here because I don't use some of the settings because that's not my trading style. I like to keep my charts as clean as possible. So as you can clearly see that right now we have this indicator, but you can see that it identified few fair value gaps. This one was filled. So if you want to get this indicator, guys, you can get it. The link will be in the description. You will find the link to visit Flux Chart. The link will be in the description below. You'll find everything here. If you use the link in the description below, it will only give you a discount, and also it will help the channel out so that you can keep receiving this free trading education videos. And also don't forget to use my coupon. You'll find everything in the description below. So let's continue with the video. We were around this area, how to use a fair value gap. So from here, right now, because you know that you can use fair value gap for take profit, retracement, analysis, and stop loss levels. But right now you have to see which one you can use, because sometimes you can have like even 5 of them in a bullish trend or in a bearish trend. So let me show you some ideas that you can use so that it can be helpful to you guys. Let's see. The first one is that you can use this fair value gap. Mostly the highest one that that are having high probability are in a trending market or after a break of market structure, where price is likely to trade below or above internal swing. Let me show you what I mean. In a fair value gap, a fair value gap that is in an impulsive wave, most of the time you will see that an impulsive wave is 1 here, 2, 3, 4, and 5.